If we take it just as an accepted fact that finance, like every other technology or every other industry, is a better way to put it, is going on the internet. So maps have done it. So I don't have an A to Z, if you remember those from your time in the UK, under the seat of your car. We use Google Maps or we use Apple Maps or, whatever. We don't have CDs in our car anymore. We use Spotify or Apple Music or whoever. So all these other industries have made that migration to the internet. So a bank has got to figure out how it can start to change those systems and change those practices and controls and everything else and the governance and the regulations and so on in order to be able to deal with a T0 environment.
Joining me on the couch is Nick Philpott. Nick's from the UK and he's the co-founder of Zodia Markets.
People look at crypto and just think, it just looks complicated.
No, but that's true. That's true. Even to someone like me, I have to go back maybe a decade or less when it first came around. Yeah. It was actually touted as something as, Arjun, you're maybe 10 years too old for this. And I was 10 years younger than I am.
Yes.
Right?
Yeah, exactly. Well, I have elderly relatives who say, oh, you work in Bitcoin.
Welcome to today's episode of Couchonomics with Arjun. Joining me on the couch is Nick Philpott. Nick's from the UK, and he's the co-founder of Zodia Markets. Nick, welcome to the couch.
Thank you for having me.
Right, and I guess it's a big week for, the crypto world.
Yep.
There's Token 2049 going on in
That's
Dubai.
Right. Yep.
But I think more interestingly, Bitcoin is either about to start halving or has begun halving because it was going to happen around the 19th or the 20th.
The way it was programmed by Satoshi Nakamoto so many years ago.
Well, it's very interesting that you mentioned Satoshi Nakamoto. I actually had David Shaum on the couch at the end of season 2.
Right.
And I guess my opening question to him was, is he Satoshi Nakamoto? Is there a group of them together as Satoshi Nakamoto? I guess it wasn't the first time he had dodged that question. But that's interesting. So let me start. I want to hear everything about what Zodia Markets do, and you're an OTC crypto brokerage.
Correct.
I guess focused on institutions.
Yeah.
But let's just talk about a little bit about Bitcoin and what does. I guess there's a few questions here.
Yeah.
What does Bitcoin halving really mean?
Mm-hmm.
Right. Why is it so significant?
Yep.
Right. What's going to change?
So Bitcoin is secured by something called proof of work. And proof of work is a technology that existed before Bitcoin, and it's used in email, amongst other things. It's actually designed to deter spam. So what that involves is validator nodes are basically trying to solve very, very difficult maths puzzles. The way to solve those maths puzzles really is through vast quantities of trial and error. Mm-hmm. So vast that actually it becomes a function of the amount of computing power, and then as a next step, really the amount of electricity you can throw to provide that power in order to solve that maths puzzle. Whichever validator manages to solve the maths puzzle gets to add the next block. Obviously, that's the block in blockchain, and the Bitcoin network provides a reward. And at the moment, that reward is 6.25 Bitcoin. So whatever that is, that's about 360, something like that.
Yeah, we're at 64,000.
Yes, the $64,000 question.
Yeah,
indeed,
it is a $64,000
exactly.
question.
So those new coins, that's known as Coinbase. That's where the name Coinbase comes from. And over the course of the next day or so, that amount will halve. So it'll go from 6.25 Bitcoin per block to 3.125. Now, there's a lot of people who are asking, how is this going to impact the market?
Yeah.
In sort of trading circles, you would refer to that as, buy the rumor, sell the fact sort of thing. So actually, there's been so much rumor or so much speculation or so much discussion about what the impact will be that actually when it happens, very little will happen because
the price is baked in.
It's baked in, exactly that. So I personally think that actually it'll have a lot of impact on the miners.
That's what I thought. It disincentivizes them.
It causes an adjustment to their business model.
Okay.
So where before they were earning 6.25, or they were competing under race conditions against other miners to earn that 6.25 Bitcoin, they're now only going to earn 3.125. So as a result, they then have to factor electricity costs of the kit, costs of the premises and location, all those sorts of things into their business models.
Okay, so I understand Bitcoin, I understand the concept of halving, the impact of the miners, but if I just take a slightly, I guess, more holistic view, does that actually impact the broader market in any way or the other? Does it impact trading patterns? Any of that? Does any of that change?
At the moment, we think, a lot of the trading patterns is being driven by the ETFs, particularly out in the United States, although I think it's just this week, Hong Kong has announced that they're going to permit ETFs.
Okay.
I think if I recall, the UK is also gradually moving in that direction of permitting ETNs, I believe it would be in the UK. I think on a volume basis, that's driving the market a lot more than perhaps the change in the halving that we're about to see over the course of the next year.
And I'm sorry, I'm going to explore this a little bit further because I saw an excerpt of an interview with Larry Fink, I think BlackRock's
that's right.
CEO, and he talked about that in the history of ETFs, the Bitcoin ETF was the fastest growing or subscribed ETF ever.
That's correct.
Did you guys expect that?
I don't know if we expected it. So at Zodia Markets, we only do spot.
Yeah.
Okay, so we don't engage in ETFs. We don't serve US customers at all at the moment. So to an extent, we were watching what was going on almost with academic interest, if you like. Certainly impacts price, but we're a match principal broker. So what's coming in is going out straight away. We're majority owned by a bank, and under the capital rules that banks are beholden to, they have to allocate a large amount of risk capital against any crypto holdings, a really large amount. It's effectively discouraging banks from holding any crypto on balance sheet. That seems to be the ultimate objective. But as a result, because we're a subsidiary, we're part of a banking group, we're not allowed to hold anything on balance sheet, not anything material. So in terms of pricing, it's great for us because it's prompted more activity on behalf of our clients.
So the institutions are getting up. I would imagine they would be the reasons why the ETFs did well.
Exactly. And we're looking to start serving ETF issuers in other jurisdictions. So one of our specialities is offering crypto, but against foreign currencies. Because a lot of crypto service providers, VASPs, virtual asset service providers, whatever you want to call them in different jurisdictions, they still struggle to get access to basic banking services, let alone foreign exchange. So they're struggling just to get US dollar bank accounts. We are in the slightly privileged position of being able to open a lot of different bank accounts in lots of different currencies, particularly in those currencies of those countries where crypto is, and Bitcoin in particular, is even more heavily demanded than it is in somewhere like the United States. If you are in somewhere like Nigeria, for example, where you've had the currency collapse, or Turkey, for example, there's been a huge amount of volatility there. Argentina would be another great example.
There's a direct correlation between success and correlation and the lack of in the economy.
I've heard some people refer to it as a Bitcoin as a short the sovereign trade.
Okay, well, fair enough. Fair enough.
But it means that there's probably a more visceral demand in some of those jurisdictions, as opposed to the United Kingdom or the European Union or the United States, where it's more speculative, it's more sort of trying to earn money rather than trying to protect your wealth from fiscal oppression or debasement or whatever term you want to use.
I think we got a little ahead of the
sorry.
audience. So I'm gonna drag you back. So Zodia Markets, right? Simple question, right? What is it that you do? In simple, I guess, term, what need are you fulfilling out there?
It's a good question. So we don't serve retail customers. So I'll start with that. We don't do the man on the street, natural persons, as we would call them. We only serve legal persons. So you have to be a company of some kind, a company registry and all the rest of it. What we do as a OTC, so OTC is over the counter. So in the old days, it would literally be over a counter. They will come to us and ask us for prices in crypto versus fiat, or crypto versus crypto. We'll provide them with a price. If they like the price, then we'll execute and we'll settle the trade after that. And all of our charges and fees, just like is the case in foreign exchange, are baked into the price. So it's just like foreign exchange. On the other side, we then have access to liquidity providers. That includes our majority shareholder, Standard Chartered Bank, on the foreign exchange side. Or we have access to exchanges, and what we're doing is the risk. So for example, if someone has asked us to sell them Bitcoin, but they've given us dollars, we will take those dollars and we will go and buy Bitcoin from one of our liquidity providers, exchanges, or whoever it might be, and then we'll deliver that to the client, and we will face the client directly.
So there's no custody, there's no holding. You
We don't, yeah.
It's in and out.
Exactly. So what we've tried to do, because I'm an ex-banker for my sins, many of us in the firm are also ex-bankers, and we've tried to bring some of the practices, the good practices from banking, and the way things are done. Because for a lot of those large companies, whether they're financial institutions or corporates, it makes it much more recognizable. And as a result, it makes it much easier for them to start transacting in cryptocurrencies because it just feels familiar. Effectively, we're making the unfamiliar familiar, if you like. So one of the ways that we do that is by being non-custodial. What do I mean by that? If you were trading on FTX, you would have had to give FTX some money, or your crypto or whatever. You would have basically allowed them to hold your assets. Now, you do that with a bank. If you want to trade on, I don't know, ADCB or BankFab's platform or whoever it might be, it doesn't matter. All the banks are the same around the world. You'll have some funds with them. They will show you your balances and you go and trade. Now, there are controls and there are sort of discipline measures effectively within banks to make sure that your funds are safe. FTX, as we've seen with the court case, your funds were not safe. They were effectively, to borrow the phrase, putting their hands in the cookie jar. And as a result, they lost a lot of those funds, and those funds they were gone, albeit it seems that a lot of the creditors to FTX's estate are actually going to wind up making money because of the time since the crisis happened. But as a result, Zodia Markets is non-custodial. We use third-party custodians. One of them is our sister company, Zodia Custody. So same parentage, but different governance, and all the rest of it. We use Coinbase, we work with Fireblocks, and we're adding more custodians because we want to try to be custodian agnostic. Mm-hmm. But the punchline, the important thing is, if we go bankrupt, something happens, your assets are still in custody, they're safe, and they're segregated from our balance sheet.
Okay, so if I just take the question in continuation, right? Mm-hmm. So for your institutions who you're serving, right? The need is they want to speculate on a asset class?
Or yes and no.
Okay.
So when we first set up, that was our original business plan. We were going to provide access to the main cryptocurrency. So not the long tail, the altcoins, but Bitcoin, Ethereum, obviously, but then Chainlink, Uniswap, Aave, Comp, and so on and so forth. And we were going to offer that against effectively what we call G3 currencies. Mm-hmm. So sterling, US dollars, and euros. Mm. We had a couple of stable coins on there as well. So Tether dollar and USDC, Circle's USDC. Mm-hmm. That worked reasonably well. I mean, we launched in September 22, straight into the teeth of the crypto winter. Almost at the same time that Three Arrows Capital, Terra Luna, gosh, what else? Voyager Digital, Celsius, then FTX, then the three banks, so Signature, Silvergate, and Silicon Valley all went under. So it was hard going. Middle of last year, had something of an epiphany, and we realized that, particularly after those three banks that I just mentioned had collapsed, a lot of our counterparties were really struggling for basic banking. Mm-hmm. And we thought, well, if they're struggling for basic banking, then they're definitely going to be struggling for foreign exchange, particularly in those currencies where, if you look at the top 20 countries in terms of crypto adoption, a lot of them are, what some people will call re-emerging or emerging or developing markets, frontier markets, if you like. So places like, Nigeria, for example, Argentina, Indonesia, Vietnam, and so on and so forth. So what we did is, because we're majority owned by a bank, we have that sort of inbuilt advantage. We can open bank accounts. We opened 16 currencies worth of bank accounts. It'd be 19 at the end of this month. And we focused on stablecoins. Now, a lot of our clients, because they're struggling to get access to banking, and because crypto operates in what we call a T0 environment. Mm-hmm. So just to put that in context, if you buy or sell a stock or a foreign currency or something like that, you execute today. So you might have dirhams, you want to sell me dirhams, I then give you dollars. But what's today? Friday. We wouldn't settle until Tuesday, so 2 business days. Crypto doesn't work like that. You and I trade today, we settle today. Okay. And it doesn't matter if it's a weekend, we settle today. That's very difficult because the entire banking system is geared and rigged for T+2, 2 business days. So as a result, what we have done is we've worked with our banking provider so that we can do stable coins versus foreign exchange today. And that's a non-trivial exercise. So for example, someone can give us Turkish lira and then we can deliver dollar stablecoins to them today. That enables them to run their crypto asset businesses as smoothly as possible, and they can give their clients the T0 settlement that they expect. So that's the first sort of big use case. That's crypto natives, people who are already active. The second group are corporates. And this is probably something where people have not really seen much yet. So we have a couple of clients. One of them, I'll give you an example. He buys stable coins from us. He's based in Africa, and he uses those stable coins to buy oil.
Okay.
His oil supplier is in the Middle East. The reason he does that is if he wanted to use the fiat correspondent banking system, what he would do is he would have deposits at his bank. The shipload of oil would arrive in harbour. The exporter would say, right, oil's there, pay me. He goes to his bank, clicks pay this bank account in the UAE. What would happen is his local bank would then have to move the local currency, probably to another local bank that has what we call a correspondent banking relationship with a US bank, because you have to go to dollars. If you have an African currency, you'll almost certainly have to go to dollars before you can get to, and I'll just use dirhams as an example. The dollars clear in the United States. That goes through a system called Fedwire, and Fedwire, the local payment system, is basically a series of Oracle database clusters. So that'll go through one, maybe two banks, and then it comes around the world a couple of days later, and you get to the UAE, and you may still have to go through another bank, because the last American bank's correspondent into the UAE may not actually be the UAE bank of your destination pay.
Totally agree.
So instead, what he does is he buys dollar stablecoins from us, and he sends them directly to his oil supplier in the UAE. Really quick, really simple, and he's done in about 4 hours. If I explain it just in geographical terms, it's probably an easier, more intuitive way to understand it. If you are in Africa and you want to pay someone in the UAE, you don't go east, you go west. You go through the United States, you come back around the world, and you land in the UAE. With stablecoins, you're finally able to go point to point in the direction you actually want to go, which is east.
And that's very much, if I'm not wrong, that isn't dissimilar to why I guess stablecoins are being used for even normal money exchange,
yes, is it?
correct?
Yeah.
It's the same whole argument in terms of not having to hold money. The speed of movement is greater.
Correct.
It's very interesting. So I've got a question for you.
Sure.
You've mentioned a few times about the parent here, right?
Yeah.
So the parent is Standard Chartered.
Correct.
Right. I hear the benefits.
Yes.
Right. I'm sorry, I'm going to put you on the spot, but
please go for it.
But you're trying to be fleet-footed, agile, prompt, do things in minutes.
Yeah.
They're, as you said, hardwired to operate in a certain manner.
Yeah.
There's a certain, and it's not just the technology, but there's mindset, there's there's context, there's governance, there's stuff.
Controls, regulations.
How does this all come together in terms of, what are the benefits? What are the challenges? How do you guys overcome those challenges?
That's a good question. So if you look at it from the bank's perspective, so the bank created something called SC Ventures a few years ago. And the whole idea behind SC Ventures was to rewire the DNA in banking. Now, if we take it just as an accepted fact that finance, like every other technology or every other industry, is a better way to put it, is going on the internet. So maps have done it. So I don't have an A to Z, if you remember those from your time in the UK, under the seat of your car. We use Google Maps, or we use Apple Maps, or whatever. We don't have CDs in our car anymore. We use Spotify or Apple Music or whoever. So all these other industries have made that migration to the internet. Finance still hasn't done that. So for example, when you go onto a website to buy something, you click buy, suddenly you get taken to your card issuer or some other page, which is known as a payment gateway, that is effectively providing that gateway to the government-run or the public sector payment system, which is not internet-based. So as a result, you don't have the utility, the speed, the accessibility, the universal access of the internet. I just feel like it's physics. It's inevitable. Money is going, and value and assets and the way that we run financial services. So effectively the way that we move value over space and time and context is going on the internet. So as a result, if you're able to move it onto the internet, then it's going to start moving at the speed of email, which is almost instant. So a bank has got to figure out how it can start to change those systems and change those practices and controls and everything else and the governance and the regulations and so on in order to be able to deal with a T0 environment, because it's just going to happen. So as a result, they set up companies like Zodia Markets, which is effectively like a frontier company. And we're going out there and we're figuring it out, but we're figuring it out with them. And in some cases, we're finding capabilities within the bank, such as some book transfer. So book transfer, as a simple example, if you have a bank account with a bank, and I have a bank account with a bank, then moving cash from your bank account to my bank account actually should be almost instant. And indeed it is. I mean, in Standard Chartered, you're doing it in about 3 minutes. The reason for that is because you're not having to go to the government system and back again. You're just going point to point within a closed ecosystem, super quick. Now, those products were developed for different use cases, but as a result, we're now turning them and pointing them at digital assets, crypto assets. And this is one of the things that people, I think, forget about innovation. They always think that innovation, you have to invent something new. You have to, be in a lab and have that eureka moment. Ta-da!
Yep.
Exactly. Whereas actually a lot of innovation is finding existing technologies and finding a new use for those existing technologies. So, air conditioning. Air conditioning was originally created to keep paper dry in paper mills until someone realized, wow, this factory is actually really cool. Can we put this in my house? And it's the same thing with the bank. So, yeah, I think the bank is feeling that pressure.
I totally get that, right?
Yeah,
so SC Ventures is one example.
Yep.
Every other bank has a number of others. Some have CVCs, others have venture builders,
exactly.
so on and so forth.
Yeah.
Right. Two questions, and let me know if one of them you can't answer. One is, firstly, I want to understand is, what's the ownership structure of these companies? Are you entirely owned by SC Ventures?
80%, going up to 84%.
And the rest of that is
it's a company called OSL,
okay,
who partnered with Standard Chartered. They are a exchange operator, a brokerage, and a SaaS provider in Hong Kong and Singapore.
What about individuals who are running the business?
So there's the two co-founders. There's myself, so I come from the Standard Chartered side, and then there's Usman Ahmed, who's our CEO, the other co-founder. He comes from the OSL side. He was their chief information officer.
But I'm sorry, do you guys have equity in the business?
I won't discuss that, if you don't mind.
Okay, that's fine. Let's move to the second part of the question. Is how much operational, I'm going to use the word meddling, is there from the parent company?
There was a lot before we launched, and rightly so, because the bank had to demonstrate to its regulators and to its various other stakeholders that what it was doing with us to set us up, and the same goes for Zodia Custody, was not going to threaten the safety and soundness of the bank.
Okay.
Once they've done that, and they've given us our risk registers and our control frameworks and all those sorts of things to their satisfaction, they've effectively let us run with it. We are subject to internal audit, like every other part of the bank, and an independent internal audit, part of that reports up to the actually, Standard Chartered's weird. It doesn't have a board. It has a court. It's all very grand. But yeah, so we are subject to internal audit. So that's the verification process. And obviously we have reporting into the bank. But ultimately, if they interfered with us day in, day out, they would smother us. The whole idea is to create a small group of highly motivated individuals, pretty experienced individuals, to see what they can do with very different tools from those available to probably a lot of crypto natives. So it's very positive. We can get bank accounts, we can get foreign exchange, but there are negatives. We can't hold crypto on balance sheet with ease because of consolidating up to the bank. So the exchange order stamp complications for another.
I've got lots of questions on that, but we don't. Let's shift. You brought the regulator in, right?
Yep.
So my understanding is regulation is at its nascency.
Correct.
Wherever in the world you look for it, right?
Yeah.
In the whole concept of digital assets, whether it's DeFi, crypto, whatever the favorite word is that, right? And a lot of it is left to interpretation, right? Obviously, the bank has chosen to interpret it more overtly for the right reasons, right? Because they actually have a responsibility being a bank, and most banks are over-regulated, if I may use that term, in different parts of the world, right? How do you guys as a business sort of deal with what I may say the apparent ambiguity which sort of exists out there, right? And are you allowed to be as stealth and as flexible as some of your, I guess, your peer group are?
Stealth? Well, I mean, so a lot of people say, particularly in the institutional side and on the banking side, they don't want to get into crypto assets until there is regulatory clarity.
Sure.
I reject that completely. And I don't reject it because I want to operate in some grey area or, be a fly-by-night bunch of, scallywags.
Scallywags.
There you go. Sorry, scoundrels. There you go. It's an easy one. So the reason is because there is already a large corpus of regulation that you can look to and go, well, that makes intuitive sense, and effectively taking the spirit, perhaps if not the precise letter, because sometimes retrofitting it perhaps is not precise. But there are a lot of things that you can just read across and go, well, even though that doesn't apply to me, I'm just going to pretend that it does, not because I want to be regulated, but it's because this is just a patently sensible thing to do. It is an honest thing to do, because really, if you synthesize the vast majority of regulations down, they say don't lie, don't cheat, and don't steal. That's more or less it. Mm-hmm. I mean, they say it in many different ways, but that's basically the gist of it. So there's just thinking about that. So for example, here you go, I'll give you a really clear example. So in the UK, there are laws around the segregation of client assets. Mm-hmm. Again, something that FTX patently and publicly failed to do. Those rules are known as CAS, the Conduct of Client Asset Sourcebook. Now, because we're not regulated, we are registered in the UK under the anti-money laundering laws, and that is all the regulations that exist for spot crypto in the UK today for what we do. Mm-hmm. So we wanted to start offering segregated client accounts. So we went to the FCA and said, and our auditors and the bank, we said, we're not regulated, but we would like to pretend. Do you mind? They said, absolutely not. In fact, the FCA said, please come in. We'll spend an afternoon together. We'll want to learn what the ins and outs are, because we're thinking about either how to write new regulations or to retrofit existing regulations, and we can kind of learn together. But we completely get the spirit and the objective of what you're trying to do. So go for it. And this is what we like to see. Honest actors trying to do the right thing without sitting there going, someone needs to write something precise before I have the ability to actually think, because I lack the ability to think independently.
But so it begs the question, did you do that as an independent entity?
Yes.
Or is the industry, as in your peers, all coming together and doing that with the FCA and with the other regulators? And I do want to come to the UAE, where you're also now, registered / regulated. You look right the right word is.
No,
but let me go to the former question. Are you the exception, or are you now a part of a greater collective of people doing similar things to you who have gone to the regulator and said, let's sit down together?
It's a bit of a mixed bag, mm-hmm. I think. There's certainly far, far fewer bad actors out there. Yeah.
No, so again, my question is not the good and the bad.
Yeah,
right?
yeah.
So you can take an industry as simple as buy now, pay later.
Yes.
Okay, right?
Yeah.
There's no rocket science involved in that industry, right?
Yep.
I saw that there were BNPL players who wanted to go speak to the regulator quite early in the curve.
Yeah.
Some who did not want to. The ones who did not want to weren't necessarily doing anything wrong.
Yeah.
They were just saying, I'm just not going to go and have the bull ram me for no reason.
Yeah.
So from that perspective, is the industry coming together, or are you being encouraged to do that because Standard Chartered has the has the ownership and so on and so forth?
I think we do it just because we think it's the right thing to do, because we are trying to demonstrate that this is the way that things can be done. We do see a couple of our peers doing the same sort of thing, but the vast majority of them are crypto natives. I mean, there are vanishingly few banks that are actually directly active in spot crypto assets. There are those that are trading, futures at the CME, cash settled futures. But I mean, as someone sort of wryly observed to me, you can trade wheat futures at the CME. That doesn't make you a farmer. Mm-hmm. It's a bit harsh, but okay. Yeah, mm-hmm. I see the point. So we're one of the very few that's actually active in spot. The others are sort of crypto natives. So they don't necessarily come with, a career of having done MiFID II, which is a very large regulation, for the benefit of your listeners, in the European Union, the UK. And various other regulations over the course of their careers. So we probably come with that baggage. And there's bits I would definitely quite happily leave at the door, but there's bits in there like CAS where you just go, it's just a good idea,
So you're now here. Mm-hmm. You're regulated with the register. What's the right?
We have our in-principle approval from the FSRA, which is the regulator in ADGM. We got all the acronyms in there, which is in Abu Dhabi. Okay, it's the financial free zone in Abu Dhabi. We are also talking with a regulator here in Dubai, because we want the financial free zone, but we also want something onshore. And obviously Standard Chartered is has a significant presence here in the UAE and is in both financial free zones, DIFC and ADGM, and then also in offshore.
Offshore. Okay. Yeah. So you're at that space. Now, now the question I have is, obviously, as you said, there are a few banks which are in the spot sort of trading business. I'm assuming you're expecting more will come along.
I hope so, yes.
Right. And obviously you want to get to an environment where regulation becomes less ambiguous, especially with dealing with institutions. That will help you tremendously.
Yeah.
Is there enough of a network coming around between you founders, co-founders, owners? Doesn't matter, crypto native, non-natives, whether they are.
Yeah.
Because I actually cannot see, unless you guys don't all come together, I think you're just delaying the inevitable and sort of creating more confusion, right?
Yeah.
Because, and then, or you, worst case scenario, you land up with a set of regulations, which is sort of a halfway house between where you guys want to be.
Exactly.
How do you see, and again, maybe this is a crystal, I always say a crystal ball and regulation are two sentences which shouldn't be in the same sentence, but here I'm going to put it. What's the Nick crystal ball on how do you see regulation evolving, and how do you see that catalyzing greater volumes from the institutions, corporates, financial institutions, however you want to define them? Yeah. Right. Taking a greater, if I may say, interest in what you guys do.
Yeah. No, it makes sense. My preference for a regulatory approach is a regulation that focuses on outcomes rather than really trying to dictate how you're going to do something. In crypto assets, there is so much development in so many different directions, it is almost impossible to keep up. I mean, that's part of the appeal. There is a lifetime to learn here, and the universe is expanding faster than I can read personally. So I think allowing that flexibility by setting the outcomes. What do I want you to do? I don't want you to lie, I don't want you to cheat, and I don't want you to steal. Here's a little bit more detail on how to achieve those outcomes as the regulator, interpret them. And then I think we'll start to see more and more banks start to create, as Standard Chartered did, a sort of center of excellence. So rather than having lots of different projects popping up like mushrooms all over the group, you try to bring it into some sort of central cohesion, and that way you can, give it a bit more direction, a bit more control. They will hopefully speak to people like us, and to an extent we can sort of share the playbook a little bit and just explain, some of the ways that we did things. And that, yes, it might create some competition in a way, but it will grow the pie. And I think at the moment it's more important to grow the pie rather than try to keep people out, make it into some sort of private members club or something like that. You want to try to democratize it, if you like. And
so the question is, and I guess this leads me to the next question. This is something which just came to mind. And do you think with more and more, I don't know, there's like 140 or 180 central banks who are currently involved in CBDCs, and as they start to bring those on, whether wholesale or retail or both, I guess they get more comfortable with the concept of digital currencies and crypto. And do you feel that's going to give you the halo effect, and then other parts of this crypto world get sorted?
The problem with central bank digital currencies, which are it's effectively crypto, but it's almost like a centralized, controlled system. So it's almost a contradiction in terms. I can see the application for domestic purposes, so it makes total sense. But if you're going to start to move money across borders, then if you have whatever it is, like 160 currencies, if you're going to have a bilateral connection between each network in each country, then what is that? It's like 16,000 or 18,000. I have to do the maths in my head. Different connect. It's a frighteningly large number of bilateral connections. So maybe you'll see some, corridors like Switzerland to the EU. That would probably make sense, or US to Canada.
Some of the trade corridors might. You have these, I guess, national payment infrastructures which are coming up, or public goods which are coming up, and they are connecting with each other.
Like US, Canada, I can see them networking up, but are we going?
India's building out their network quite aggressively.
But could I see, I don't know, Papua New Guinea connecting to Peru? No, it's not going to happen.
But is it even important? Because then
I don't think it is.
But is it? If I talk the 80-20 law rule, once you got the 80% of the movement sorted, do we really care about the other 20%?
Well, the thing is because a lot of those at the moment, smaller countries are some of the fastest growing places in the world.
Okay.
And so as a result, you're going to inhibit their growth. And there's still going to be there is going to be some poor fellow who wants to move funds from Papua New Guinea to Peru. But the thing is, you want to try to create that network. The internet's already done it for you. So that's the beauty of stable coins and cryptocurrencies, is you're using the same internet rails that, frankly, email and the internet has kind of done for you, figuratively speaking. Whereas central bank digital currencies, like I said, great domestic use case. You're paying for your groceries in the local supermarket, fine. Buying Starbucks, fine. But if I'm traveling, if I'm a tourist and I've arrived here, does that mean I have to get the app in, for the local payment system to be able to pay? What do I do when the balances are unused? What if I wander across the border? Can I still use it on the other side? You get into all these sort of weird use cases. Stablecoins are on your phone. They're on the network. They'll just travel wherever you go.
So let's come to stablecoins, right? Mm-hmm. So the stable, not so stable coins, mm-hmm. right?
Yeah.
Okay. Tell us the different types of stable coins, because some of them have just not been that stable.
Okay,
either,
yeah.
Right?
All right. So at the simplest two groups are those that are backed by fiat. Is a clumsy term, but let's just say those that are backed by fiat. And then there are those that people often refer to as algorithmic stable or whatever. Right. Sort of, yeah. Everything that I'm talking about when I refer to stablecoins is that first group. It's fiat backed.
So why is there a market for these algorithmic ones then?
Because some people believe that using things like staked ETH and derivatives and all those sorts of things, that you can create a synthetic dollar. There is certainly an intellectual curiosity. Some of the designs are very elegant. Terra Luna was basically a debt equity arbitrage. It was, if I remember correctly, it was basically the same sort of thing that Lehman Brothers was engaged in. Mm-hmm. And we saw how that finished with Lehman Brothers. And this is the weird thing about sort of crypto crises, is they all have some sort of historical precedent.
They've all happened once before in the fiat world.
The ICO boom. Yeah, that happened in 1692 in the UK with the IPO boom. Terra Luna, as I said, that's Lehman Brothers. FTX, that looks very much like Refco. Rug pulls by Rugna Ignatova on OneCoin. That's Gregor McGregor selling government debt of a fake country in 1830. They all have these precedents. This is just history repeating itself very, very quickly.
with a bit more technology.
Yeah, exactly, right? Exactly. Yeah.
So it comes quicker.
Exactly. That's exactly it. It's delivering failure quicker. I mean, I'm sure some poor fellow will have that as his marketing tagline. But fiat-backed stablecoins, effectively what you're doing is you're taking fiat and you're putting it on the internet. There are lots of different designs within that. So you have onshore and offshore. And let's just do the basics of a stablecoin. I want a stablecoin, you issue it, I give you $1, you give me $1 stablecoin. Or if it's a Swiss franc stablecoin, I give you a Swiss franc, you give me a Swiss franc stablecoin. Now, the design depends on what you then do with the US dollar. Okay, and where you're doing it. So if you put it in a bank account in, Hong Kong, that's a euro dollar. If you put it in a bank account in the United States, that's $1. But then there are other things you can do with it. Are you going to put it in deposits? Which means that because I'm holding a token, I'm running credit risk against the bank that you've got it on deposit at. Mm-hmm. So maybe you spread it across a load of different banks. So, which is exactly what Circle did when they had the problem with Silicon Valley Bank. I think it was Signature Bank. They had 3% of their reserve at Signature Bank. Pardon me, I'll get my history correct. So you could do that. But then maybe you could take the vast majority of it, because you don't need it all to be cash for minting and issuing and redeeming, minting and burning. So you could put it into a money market fund. Again, similar to what Circle has done. They put it into a 2A7 fund, which is like a big money market fund with BlackRock. Or you could put it into certificates of deposit, or all these different ways that you could store it. And that dictates how I would view the credit risk and potentially the operational risk and various other facets of the token that I therefore hold. So
what you just told me in the last couple of minutes is multiple use cases.
Correct.
If I may use that term for stablecoins, right?
Well, multiple designs. The use cases, I think, are different.
So the designs determine the use cases?
Can do. Certainly can, yeah.
So beyond cross-border movement of money, what other use cases are you actually seeing gaining traction?
So if you're a mass consumer retail company, so let's say you're a hotel or an airline or a tobacco company, or take your pick, a publisher. If you're selling stuff online, One of the challenges with the internet is payments are not in the browser. Okay, they're not in the app. You have to go through that payment gateway that I referred to earlier. So if you can put a stablecoin in the browser, then you can make that selling experience, that online sales experience, that much more seamless. Similarly, if you want to pay with a physical point of sale, you can use a QR code, you can tap, so your wallet will go to the merchant's wallet and so on and so forth. Now, if you're selling stuff in some countries where maybe the local currency is a very, very difficult thing to deal with, maybe the local banks are not particularly creditworthy, so maybe you want some different options of what your unit of account, your medium of exchanges for your goods. So maybe you sell in local currency, but maybe you give some people the option to buy with a US dollar stablecoin or Bitcoin or Ethereum or whatever. So you're basically giving consumers more choice. But from your perspective, you're now no longer having to receive local currency, which in some countries, if there's an FX control, you may not be able to sell and get back to your head office. So that's a really simple use case. The other interesting thing is that has the potential to unwind the original sin of the internet. So in 1994, when the internet was first being created, that's when Netscape and Microsoft realized that they couldn't put payments into the browser. So the original sin of the internet is more or less the vast majority of the internet's economic model is predicated on advertising. And if it's predicated on advertising, the advertisers need to know about you. Are you old? Are you young? Are you fat? Are you thin? Are you black? Are you white? Are you male, female, gay, straight, whatever? And you have to collect all this personal information. And sometimes that goes horrendously wrong because you have a leak or people find out you're gathering information you really shouldn't be. You get GDPR, the Facebook scandals, and so on and so forth. If you are able to tie sales to wallets, then you can follow the money. You can advertise to the wallet rather than the person. As a result, you don't have to gather the personal information, and you can keep yourself much more safe from a legal point of view. Similarly, actually, if you can tie payments to something like a video game, which is intellectual property, then from a banking perspective, you can tie cash flows to intellectual property, and we can value intellectual property for the first time ever. So that's the first use case. Next one, the cross-border payments. It's taking payments but making them interoperable with the goods that are being sold at a wholesale level. So if I'm buying a load of oil, for example, that example I used earlier, then there's a document that represents the oil on the ship. It's called a bill of lading. Or if it's a plane and you've got diamonds on a plane or whatever, then it's called an airway bill. If you can take the bill of lading, you can tokenize that, which you can legally under the Electronic Trade Documents Act, which governs English law bills of lading, it's about 70% of bills of lading. Then it means you have the bill of lading and the means of payment, the stablecoin, on the same blockchain. That means you can do what the crypto people will call atomic settlement. In traditional finance, you might call it PVP, payment versus payment, or delivery versus payment. What that means is that there's no longer any settlement risk. Settlement risk is the risk that one party doesn't deliver. So if I sell you this mug, you say, you're going to give me the money. I'll go, great, give me the money first and I'll give you the mug. There's a risk I might run out the door with the mug. That's settlement risk. So if you can eradicate that for multiple $1 million transactions, then you can really start to transform wholesale commerce.
So here begs the question, right? So a lot of these use cases, simple to understand. Obviously, the value or the benefit is quite clear. It's efficiency, effectiveness, so on and so forth.
Yeah.
Right. What's stopping it from getting mass adoption? Is it regulation? Is it this whole point that interoperability is spoken about, but let's be honest, there are multiple rails being built and to move things, to move payment across these multiple rails is not easy. I had a very interesting conversation with a bunch of I guess crypto players at a conference down in Kigali.
In Rwanda.
In Rwanda, that we're building everything multi-rail, but I said the gas fees are prohibitive, right? And I said, you want me to actually pay you the gas fees for you to achieve this, so I'm actually subsidizing your future.
Yes.
So what's really stopping rapid, massive sort of growth?
There's multiple things all at the same time combining to create a large amount of inhibition. So I think I don't know, I'm not in no particular order, although I know what the number one biggest, and I'll finish with the number one biggest. Okay, right. Save the best to last. first of all, is just this misconception that crypto assets is just all about anti-money laundering, sanctions violation, financing terrorists, all those sorts of things. It could not be further from the truth. It is one of the worst things you could possibly use to launder money. So, for example, the husband and wife team that wound up with the Bitfinex proceeds from a hack of an exchange called Bitfinex, it was hacked in 2016. The husband and wife were apprehended last year, I think. The mark to market, so the value of the assets that they stole, at one point was about $2.5 billion. It's quite a lot of money. By the time they were apprehended, they managed to successfully, as I saw reported, they successfully managed to launder about $100,000. It's pretty poor for performance. And effectively, what the husband had done is he'd gone to a bullion dealer, tried to buy gold bullion with Bitcoin. Because the bullion dealer was regulated, he had to show his driver's license, and the FBI or the police or marshals or whoever it was turned up at his door 2 days later, or maybe a day, I don't know, very quickly. So it is horrifically bad as a tool to use to launder money or finance terrorists, or and so on and so forth. So that's the first thing, is that misconceptions. Get that out of the way. I think the next thing is that too many people, I think, are chasing the complex. They want to they think almost in thermodynamic terms. I need to do something really, really hard in order to have a massive outcome. Actually think the other way around. Think lazily. What is the laziest thing you could do that could have the simplest thing to do? Let's reframe it. That can have the greatest outcome. So people are trying to tokenize securities or carbon credits or things that just sound horrendously complicated and are quite regulated. Instead, you could focus on something like a bill of lading, which is a really simple document. See that ship? You own what's on that. Any questions? Nope. Great. Okay, off you go. So focus on simple things, and actually you'll find that you can make the biggest difference. And funnily enough, as I just mentioned, they wrote a law for it back in September and passed it. So the tools are there. So sometimes people just overlook the obvious. And last but not least, and most important, is education. It's just that understanding. People look at crypto and just think, it just looks complicated.
No, but that's true. That's true. Even someone like me, I have to go back, I don't know, maybe a decade or less when it first came around. Yeah. It was actually touted as something as, Arjun, you're maybe 10 years too old for this. And I was 10 years younger than I am.
Yes. Right? Yeah, exactly. Well, I have elderly relatives who say, you work in big coin, don't you? So there's some giant coin somewhere that we're dealing with. No, I reject that. I'm not a computer scientist. I'm a historian. I have 2 degrees in history. So I think it's actually just people not explaining it simply enough. So, for example, if you're trying to explain something like hashing, right? So taking a piece of data, large piece of data or a small piece of data, doesn't matter. You put it into a hash algorithm and you get an output that is seemingly random of a fixed length. How do you explain that or help people relate to that to something in their everyday lives? It's an oversimplification, but it's a barcode. You're taking a big piece of data or a small piece of data and you're turning it into a unique barcode. The moment people hear that, they go, okay, I know barcodes. I get that. Okay, that's really easy. Okay, and you go, great. Next technology. Walk through those technologies and don't explain them with the sort of infatuation over the complexity. Just relate it to something that people know in their everyday lives, and suddenly you'll get that, I get it, aha moment.
And is that the big one?
Well, that's what we try to do. We go to our clients and we sit down and we walk through, for example, the 5 or 6 different technologies that were brought together in a beautiful harmony to create Bitcoin. So linked timestamping, Merkle trees, hashing, public-private key cryptography, easy for me to say, Byzantine fault tolerance, consensus mechanisms. That's it. And there are other technologies, but those are the big ones. You go through all of those, the greatest hits, and then again, you just get that aha moment, especially when you frame it finally, that harmonious whole is really just taking funds and putting it on the internet. That's all it is. Then you probably more often, though, get the realization that, wait, money's not on the internet? Like, no. Wait till I tell you how correspondent banking and the money supply works, and people sort of recoil in horror.
It's quicker to fly to Japan than to remit money to Japan.
Exactly. Yeah. Exactly. Yeah. I had a client in Kenya complaining that he could put cash in the back of his car and drive it to Tanzania faster than the correspondent banking system could get it there. It's laughable. It's an indictment of an industry.
Now that I have you on the couch, there's a topic that I'm particularly interested in.
Yep.
I've been trying to sort of, I guess, come up the curve, and I think a number of people are. Everything to do with tokenization of real world assets, right?
Yep.
And there's a lot being written out there about it. So here's my question, right? How significant is tokenizing RWAs going to become going forward, right? Where do you think we are in this process? Right.
We still have quite a long way to go. I don't particularly like the term real world assets. It sort of implies that Bitcoin is not a real world asset, for example.
Can I use the word old world asset?
I won't get facetious or sort of split hairs. That's my fault for being be a pedant. There you go. That's the exact phrase. So no, yeah, okay, fine. So tokenizing real world assets. The challenge,
real estate, art,
I get
watches,
it. 100% bonds. Yeah, I get it. The challenge is still payments. What are you paying for it with? So you could tokenize, real world assets. So you could move shares in a building as quickly as email. Fantastic, terrific. The problem is, if it's Friday today and we make the payment, your money's not getting to your account until Monday, probably.
Okay.
If it's a large payment. If it's a small retail payment, then fine. There are plenty of faster payment systems around the world, but they have caps of 100,000, 200,000, whatever it might be in different jurisdictions. So if you're buying a house, even a share of a big building, you need like $1 million, $500,000. So the faster payment system is not available to you. So that's the challenge. Until you sort of address the elephant in the room, which is cash, then all you've got is a three-legged stool. You got stool number one is the internet that you move everything on. Leg number two, pardon me, not stool. Leg number one. Leg number two is the real-world asset, and you're still missing leg number three, which is the means of payment. Ultimately, though, I think it could be absolutely transformational but in a sense, we're bringing ourselves all the way back to the beginning. So you probably heard the story, but the island of Yap down in the South Pacific, the way their money operated was giant rocks. Mm-hmm. If you've ever heard this, mm-hmm. Rye stones. Mm-hmm. And so the ownership of the rye stones was moved around by oral history.
Oral history. Yeah.
And effectively, we're doing the same thing. So you have your tokenized asset, that doesn't move. The building's not moving. You're not moving that anywhere. But the tokens move around it effectively. And the token represents that oral history, or at least a digitization and a democratization of the oral history. And there are markets that operate like that. Gold operates like that. All the gold that's being traded is in the same vault. Ironically, you've dug it up out of the ground, you turn it into bars, and then put it in the vault back in the ground again. But effectively, what you're doing is you're just moving labels around. Didn't mean to know that. You're moving labels around on the drawers that contain the gold bars, but the gold bars aren't actually moving. So we're just going to do that with more stuff.
So how do you solve for this payments issue then?
In my opinion, it's stablecoins. I think there are.
But that can't be that hard then.
You'd think so, but then you get back to the inhibitors of, people thinking it's all for money laundering and things like that. So
it comes back to education.
Back to education. So disabusing people of their prejudices, but also just enlightening people about actually what's going on. It's just money and value moving to the internet.
But isn't there like a regulatory, judicial challenge also in terms of co-ownership?
That is true. Although the UK, or England and Wales, I should say, I can't speak for Scotland, we're slightly spoiled because the English Law Commission did a huge study. I haven't read it. It's about 300 pages long. I don't have the stomach for it. But our general counsel assures me it's a phenomenal read. But effectively, they came up with a new type of property to accommodate, digital scarcity that we've managed to create. This idea that this thing that is digital is yours. And rather than just taking a digital dollar, you go, ooh, Control C, Control V. Now I have two digital dollars. You need to be able to prevent people from doing that. But in England and Wales, there is now this concept of this new type of property. And as a result, it slots into the legal system quite nicely. Other jurisdictions will follow.
Yeah,
no doubt.
I think I'm fascinated by the topic. Tokenization's been around for a while. The concept of tokenization has happened. We've had the gold certificates and stuff, which with tokens. And as you said, you could go back to a millennia to see some form of tokenization of old world assets.
Yes, yeah, there you go, yeah.
Assets. Let me take...
Well, one thing I'll flag quickly, very quickly. I apologize for interrupting.
No.
But the place where it will be truly transformational is the tokenization of intellectual property.
I agree with you.
So copyrights, trademarks, and industrial secrets. So
I like industrial secrets.
Yeah, exactly. The Coca-Cola recipe. That's a good example. Copyright, a brand. Couchonomics, MasterCard, that's a brand. Although code base, so a video game. So let's take Sonic the Hedgehog. Yeah. Sonic the Hedgehog is a brand. Sonic the Hedgehog, Sega, and then you've got the code base which you can copyright, so you can protect it. It's yours. Now, as I was saying earlier, if you tokenize that intellectual property, so every time someone downloads Sonic the Hedgehog and they pay with a stablecoin or they pay with some means of payment that you can track and you can tie to the intellectual property, then you can assign value to it. You now know the cash flows. Now, the problem with a lot of banks is that when you're looking at the types of property that you're willing to lend against, people, plant, machinery, real assets, all those sorts of things, these are all real things. If you look at the market cap of the biggest companies in the world, they are intellectual property companies. Meta, Facebook Meta, Apple, and so on and so forth. Apple doesn't make iPhones. Foxconn makes iPhones. Apple just comes up with great ideas and branding and all the rest of it. So it's very hard to lend against intellectual property. If you can tie payments to intellectual property, you can start to value it. So you can create value that right now is invisible to the entire financial system. If you can do that, then I think you're going to start to revolutionize the financial system, because frankly, you can start to unpack corporations. So for example, if you want to invest in a great film that Disney's going to come out with, unfortunately, you have to go to, I'm guessing NYSE, it's probably not a NASDAQ, I'm assuming NYSE, and you buy Disney stock. But you might hate theme parks, and you might hate every other film that Disney produces. But unfortunately, you're stuck. You have to buy Disney stock. Similarly, if you're an ethical investor and BAE Systems has come out with or Rolls-Royce has come out with a great jet engine, unfortunately, you can't invest in it because Rolls-Royce also creates defense and dual-purpose goods. So instead, if you can start to unpack these corporations into their pieces of intellectual property, you can pick and choose. I want that film, not the theme parks, and definitely not that film. So now you can create these portfolios and you can start to unravel these large corporations. And as a result, you can have companies that just create. We just create films. Once we've created it, someone else distributes it. Similar to iPhones. I create a great iPhone. Someone else manufactures them. Someone else does after sales service. Or someone else does the financing. You can start to break capitalism down into its component parts.
Well, that's where I thought, and that's exactly the thought, about 2 years ago when the conversation, the first time, or 2 or 3 years ago when I started having these conversations, which is what enamored me about this whole concept of tokenization, because it's not even it is atomization at a level that is it's unprecedented, and we can start with certain levels. The area which I got most interested was actually in art, and how that could be used, and music and so on and so forth.
Exactly.
I'm going to bring us right back to Zodia Markets. So what's next for you guys, right? So what does the next couple of years look like in terms of where you're heading and new products, new markets? So what are you able to say? Share,
absolutely. No, it could be actually pretty transparent. So, it was middle of last year that we realized actually really what our niche could be. We were doing okay, but we've discovered something where we could be truly transformational. So number one, it's increasing the number of currencies that we offer. That's really simple. We have a number, we're making the number bigger. The next one is... And
is that you making the number bigger, or is that the bank supporting?
It's the bank supporting us. Right. So, opening a bank account in sterling or Swiss francs, pretty easy. Getting FX in it's pretty easy. If you start to move to more challenging currencies like the Philippine peso or the Nigerian naira, life gets harder. The other thing you can do is you can start to deepen your integration with the payment systems. So, for example, our Turkish lira bank accounts are in the UK. They're offshore. But there are some of our clients who are unable to settle to offshore bank accounts, so we need an onshore bank account. So we figure out from a regulatory perspective, what do we need to do? What do we need to demonstrate to the local regulator to get onshore banking? And as a result, we're able to increase our volumes and also move the funds faster. That's the critical thing. Mirroring that, at the moment, over 90% of the stablecoin market by market cap is US dollar denominated. Number 2 is euros. No one expects number 3 is Turkish lira. So we found 24 currencies with stablecoins against them. Mm-hmm. We're evaluating the stablecoins. Some will pass muster, some won't, I'm sure. But our idea is to continue to add more, and we want to create a stablecoin-based foreign exchange market.
Okay.
So that's the next thing. The last part, or last really big part, is balance sheet. So at the moment, there is really not much balance sheet in the market. Obviously, we're owned by a bank, but we're looking for strategic partners to partner up with us and to start to be able to bring balance sheet to bear. So you can start to do prime brokerage and things like that. At the same time, we're looking at ways that, the trade examples, so find a partner who can help us tokenize bills of lading, and various other use cases. So also moving into digital securities. So for that, will need a license. But things like tokenized money funds, really simple things like that. And then tokenized securities as well. So while all those other banks are doing their POCs and tokenizing carbon credits, we'll work out the cash bit, but I'm not dismissing them. We're going to head in that direction as well. But I think that's kind of feels like that's enough on our plate.
Yeah, I was going to say, I was like, you got a few things to do.
Yeah.
And while doing that, you got to continue to manage not just the regulator, but the owners.
Yeah.
And processes, and the market is changing at any given time.
And teach the new clients as well.
And exactly, I was going to get and actually building the market.
Yeah,
because a lot of this is about building the market. It's not just serving an existing demand.
And that's the joy of it, by the way.
Latent, right?
And that's the joy.
I've used that term in a long time. Latent demand. So you got to unlock all of that.
That's it.
Well, welcome to the UAE.
Thank you so much.
I know you've been here previously, but I think you moved about a month ago.
Yes, that's right. Yeah, That's month 1. I'm loving it. Absolutely loving it.
And you're in Abu Dhabi. You're in the right part of Abu Dhabi too. Yeah. Well, I'm not suggesting there's any wrong parts of Abu Dhabi, but the bits that I know. So, welcome. I'm sure I'll get the opportunity to meet you again.
Yeah.
This has been a very informative session.
I've really enjoyed it. Thank you.
I think it's one of the few sessions that my voice share has been very limited, which is usually a good sign. Right?
I'm delighted to hear it. Thank you.
It is, and I'm fairly confident that people who'll tune in will learn a lot.
Yeah.
And not just in English, but also you'll be speaking in Arabic and Hindi.
I'm learning Arabic, so I'm very excited to hear what I should sound like once I've learned the language.
Well, let me know if we've got the Arabic right. But we work with this AI agency. Called Sintar, and they've started doing this for us from the start of the season. It's worked very well. But Nick, thanks for coming in.
Shukran.
Best of luck for the future, and we'll hope to see you again.
It's a pleasure. Thank you.
All right, thank you. So, ladies and gentlemen, that was Nick Philpott, who's the co-founder of Zodia Markets, which is an OTC crypto brokerage servicing institutional clients. So not the man on the street, as he said. I'm fairly confident that you guys will find this session very informative. Nick kindly went beyond just the Zodia world, talked about tokenization, talked about stablecoins, and so on and so forth. With that, I'll see you guys next week. Goodbye. Have a good day.